Hey YouTube, welcome to Stock Wars. In this episode, I'm going to talk about support and resistance. You would have seen a lot of videos on YouTube claiming to teach you technical analysis, many of them with the title like the only TA video you need to see, which would hardly span for 10 minutes or less, guaranteeing to make you a certified technical analyst. Needless to say, that's all total bullshit. You see, technical analysis is an overlay tool to be used alongside fundamental analysis to decide execution. Many people unfortunately use technical analysis on its own standing and therefore more often than not lose money. To add to this plight, many retail traders in the name of TA revisit their preschool syllabus, drawing shapes on charts and priding themselves to be self-taught experts. Believe me, I know a lot of these people. I'm not trying to diss on anybody, but the sad reality is the difference between actual TA and this is not that wide apart for many traders. In this episode, I'll be talking about support and resistance. I will cover both the theory and show you some practical examples to better understand the same. It is important for you to understand the theory behind this technical phenomenon in detail because support and resistance is something that many successful traders and investors likewise use as part of their core strategy to decide execution in the stock markets. Now, as part of theory, I'm going to be talking about one, estimating support resistance potential, and this we will do through three metrics, namely volume, distance away, and time lapsed. I will discuss in detail about all these three later down in the video. And we are going to also be talking about the time frame decision, that is, on which time frame does this technical phenomenon work the best. And three, we're also going to be talking about the concept of round figures, whether using this pattern or not. It is important for traders and investors likewise to understand the significance behind the concept of round figures and also the repeating historical levels, which oftentimes do not make various intermediary support and resistance along the way of movement throughout a set period of time. Pattern resistance and support fields is what we're going to be ending with, and this basically means that different price action patterns have different support and resistance fields. For example, a symmetrical triangle pattern can have a support and resistance field that is more concentrated towards the axis or towards the cradle, versus a rectangular pattern where it is concentrated more towards the breakout levels. But don't worry, we'll also be talking about this later down in the video. But now, just trying to understand the basics of this concept, we're going to be looking at three scenarios to best understand this technical phenomenon. Scenario number one, if prices from 1000 rallies all the way up to 3000 and runs into trouble at 3000, which basically means oversupply at 3000, it retraces back to 2000 levels. And from 2000 levels, if it once again takes support and goes on to test 3000 levels and breaks it and closes above it, let's say at 4000 levels, then this 3000 level, which earlier acted as resistance, will now act as support. And in this scenario, one can plan a trade on the upside. Scenario number two, if it rallies from 1000 all the way up to 3000, runs into trouble at 3000, retraces back to 2000, once again goes on to test 3000, but this time instead of breaking this level on the upside, it took resistance and declined from there, breaching the 2000 levels, which earlier acted as support and therefore now will act as resistance. And in this situation, one can plan a trade on the downside. There can also be the scenario where from 1000 it went all the way up to 3000, came back to 2000, came back up to 3000 again, and once again took resistance at this level, and once again came back up down to 2000, and once again took support from this level, and once again went back up to 3000. This is what is known as a sideways market. It's called a congestion, it's called a distribution, or anything you want to call it. However, as far as the pattern implication is concerned, you should wait for these levels to be broken out of before you can decide which way you have to take a trade. And now, coming to estimating support resistance potential, the first thing we have to look at is volume. Usually, an old minor bottom level where only a few thousand shares were exchanged cannot put up much resistance to a subsequent advance. But a selling climax bottom where several million shares were exchanged will provide a lot of potential supply after prices have dropped well below it. And at some later date, it will attempt to rise up through it again. Also, one more thing to remember as far as volume is concerned is a sharp single high volume bottom offers somewhat more resistance than a series of bottoms with the same volume spread out in time and with intervening rallies. Now, all of this I will show you in the video, but it is important for you to listen to all of this very carefully and understand the implication behind it. Now, coming to the second thing, distance away. As far as distance away is concerned, generally speaking, the greater the distance, the greater the resistance. If, for example, Reliance declined from 2500 levels all the way down to 1500 levels and goes sideways intermittently and rallies to 2000 levels and then drifts back down to, let's say, 1350 levels. Investors who picked it up at 1500 will not greatly be concerned at 1350 levels. Should prices now drop to 1250 levels, then this 1500 resistance level will become more valid. Even so, if it drops to, let's say, 1150 levels and so on and so forth. And now coming to time lapsed, it is obviously true that a supply level only a year or two old would be more effective than one which is 4 or 5 years old. However, that does not diminish the potency of the latter. As long as a resistance zone is not being attacked, it will still be valid. If, however, attacked, some of its power has obviously been removed. Now, coming to time frame decision, as far as the support resistance phenomenon concerned, the best time frame for you to consider is a weekly time frame. However, to catch intermediate moves, you can also use daily time frame. Now, this concept of round figures, when a stock is trading at an all-time high, usually it reverses back from a round figure level because there is no clear support or resistance at that level. And this is an insight to be kept in mind while trading based on technical phenomenon of not just support and resistance, but generally as a rule of thumb. Now, coming to repeating historical levels, this is especially true for an old line actively traded stock like Reliance. Some repeating historical levels may account for formation of intermediate tops and bottom, year after year in one bull and bear cycle after another. Now, this significance has not been well understood as far as the Indian stocks are concerned because we are relatively new. But if you look at some US stocks like US Steel, you will see the importance of repeating historical levels in much more detail. Now, coming to pattern resistance, different price action patterns have varying support and resistance fields. For example, a symmetrical triangle pattern formation where you see prices converging. Usually, when this pattern begins and reaches its peak in the first swing, is where you will see the highest volume, and therefore it is at this axis point and also this converging point, which is called as the cradle. It is at these two levels the support resistance field tends to be more active. But as far as a rectangle formation pattern is concerned, it is at these breakout levels that the support resistance field is more concentrated. Also, as far as well defined area formations like that of a rectangle pattern, a rule of thumb of 10%, which is used in the distance away rule whenever you want to measure an actual resistance, if from an area formation, a well defined area formation, if it breaks out, then this 10% rule needed be adhered to. And also, this 10% rule is applicable only on medium priced issues. And what I mean to say by this is the psychology behind this is, if, for example, a low priced issue like Vodafone, which is trading for 7 or 8 rupees, even if it falls by 30%, somebody who picked it up at 7 won't feel it psychologically as much, because the dollar value here is low per stock, as against something that is costing 1100 levels. And a 30% drop from these levels would definitely have much more of a psychological reaction than that of a low priced issue like 7 or 8. So, therefore, this 10% rule must be exclusively used for medium priced issues, and also needn't be adhered to when prices break out from a well defined area formation. Now, let's look at some practical examples, starting off obviously with Reliance. And in this, we will try to understand how to draw support and resistance to begin with, or how I have drawn support and resistance in this video. One, you take the highest point from where prices began to revert back in the previous trend, and then the second highest point, and you form a zone here. And similarly, the highest point here and the highest point here on the first reversal and on the last reversal. So, as you can see, as prices broke out from these levels, one thing that is evident in this breakout is it is not supported by sufficient volume. So, this price movement possibly is not confirmed to have given out any breakout signals, because there is no volume confirmation. Now, let's look at some other example. M&M is one other Nifty 50 stock where I saw this technical phenomenon arise in the past. Here we will see how repeating historical level breakout plays a significant role in helping one track the movement of a script. As you can see, here it took resistance and here it took resistance. You could have drawn a resistance line here. But if you see in close detail, it is also the same level where we saw a parabolic fall back in 2018. So, a breakout from this level gave a clear direction for long term investors to enter in and make money. And now, coming to HDFC Life, here you can see in more detail how the concepts of trap plays in the markets and how the 10% rule comes in handy here. Had you used the 10% rule, you would have not fallen for this trap of it being a breakout. You could have waited for it to move 10% and then retrace back and break out from these levels for you to have entered into this trade. And similarly, here as you can see right now, it is at a multi year demand level where from here it took support, from here it took support, from here it took interim support. So if this breaks out, then the next support is very far away. And you go try this instructions out for yourself as rules to be followed when using this technical phenomenon, and practice this accordingly. And let me know what you think.